LinkedIn was first. Now Groupon plans to go public, followed shortly by Zynga, then probably Facebook and maybe Twitter. The next internet gold rush is on, complete with the skeptics who say it's only fool's gold in them there hills. With us to sort out the real deals from the bubbles waiting to burst is Hussein Kanji. He's a venture capitalist who recently topped the list of the 100 most influential technology investors in Europe. Hussein invests in startups, and he worked at Excel Partners with Jim Breyer, an early backer of Facebook. Hussein, always great to have you here on the show. Let me ask you this question. 5 companies very different from each other. Is it possible, when we talk about the new internet gold rush, the possibility of a bubble forming, to lump all of these companies into the same basket?
No, I actually don't think you can lump them all in. I think they're very, very different sorts of companies. I think, you look at something like Zynga, which is a gaming company, which I guess the closest analog might be Tencent in China. And then you look at something like Groupon, which is, I guess, hopefully maybe the next Amazon of this decade. Very, very different businesses. That's comparing a gaming company to an e-commerce company.
All growing very quickly from what we know. Obviously, we have seen 2 S1s, one from LinkedIn and one from Groupon, and we'll probably see one from Zynga in the not-too-distant future. But all signs are that these are very fast-growing companies. The big difference seems to be in the bottom line. Some of them, like LinkedIn, are making money. Others, like Groupon, losing hundreds of millions of dollars. Is profitability going to be the key here? Ultimately, every company has to make a profit if it's going to survive long term. Do you think investors are going to become very discriminating when it comes to earnings or no earnings? Because you can't have a PE, a price-to-earnings ratio, if you have no E.
Agree. I mean, this reminds me of what happened in kind of the mid and late 90s. You just go back to the history of Amazon, and there were a ton of skeptics around the table. And, in Amazon, in 1997, Amazon didn't really make any money. It wasn't until 2002 that it turns its first profit. And today it's trading at 80, 85 times earnings. The big question on our mind is Groupon going to follow the same trajectory? And there are lots of pros and lots of cons. It's a complicated affair, I think.
Hussein, what do you think?
I've been going through the S1. I think, there are 3 major questions with Groupon that all investors have to look at. The first is, they're plowing a ton of money into marketing spend to acquire customers. By my calculation, they're spending about $60 to get a customer who's then going to turn out to buy a Groupon. It's about 4 to 6 otherwise. So is that number going to go down? None of us really know. How are the merchants responding? There's a bunch of negative sentiment out there, but then about 45%, 46% of merchants re-up across the board on these kinds of offers. So how are they going to play out? And then we all know, Amazon's made an investment in Living Social. Facebook has tried to go into this space. Google is eyeing it. What's going to happen on the competitive landscape? Right now, Groupon's biggest advantage is they have thousands of salespeople working the phones, and that's kind of their moat. Is that sustainable? None of us really know. It's really early days. In many ways, Groupon still feels very much like a startup, and it's really not that old. It's only about 3 years old.
So should they be going public, or should they, I guess the question is, should they wait until they become a more mature company? I remember talking to Jim Breyer about LinkedIn, and he said, if I were LinkedIn, I'd be waiting a little bit longer. Or is now the time to capitalize on investor enthusiasm for these kinds of companies?
There's a ton of investor enthusiasm for these kinds of companies, which is why they're going out. The market doesn't have very many high-growth technology companies because of what happened over the last decade. There were so few companies that kind of went out. There's a ton of appetite sitting around. But as far as a business model, it's still early days. But you could have made the same exact argument about Amazon. The question is, what are they going to use this capital for, and are the institutional investors going to get rewarded for the risk that they're taking, which is early-stage risk in many ways.
Indeed. Hussein, thanks as always for joining us and providing us with some valuable perspective.